There we go.
We're live. Oh my goodness me. Right, let's pop back over to Facebook and try and go live there as well. So 3, 2, 1, and good morning and welcome to day 5 of our Bookkeeping Bootcamp. And what a week it's been. On Monday, we reconciled our bank and our cash. On Tuesday, we posted all of our sales and our purchase ledger invoices, and we posted all of our payments on accounts so that we could try and match them both up. What did we do on Wednesday, Harry?
Wednesday, we followed on and looked into our cash control, so credit control bits. And then Thursday, we moved on to our reviewing our P&L. So today, to extend on that, we're going to be looking into our balance sheet, which is actually one of the more neglected reports, I would say. Generally speaking, we find that most business owners tend to ignore the balance sheet because they don't really understand it, to be honest. So, but actually, it's a really, really useful report. In fact, it's vital, to be honest.
And quite simple. Once you understand it, once you know what the figures are and what they're telling you, it's not that scary.
Yeah, it's actually quite a simple report, but people just get a bit spooked by it. So if you are one of those people who doesn't quite understand it, that's absolutely fine. Don't worry. If you're one of those people who do understand it, brilliant. This is still going to be useful, but well done. On a genuine note, not many people can. But what we're going to do is we're going to go through some of the basics here. So we've got a bit more of an insight to what our balance sheet is and what we're looking for. So simply put, the balance sheet is simply a list of what you own and what you owe at any point in time.
Assuming it's up to date.
Yeah, that's assuming it's up to date. Otherwise, it's not quite as informative. But
it can be quite misleading, can't it? You often see that in incomplete accounts, and somebody thinks they've got assets or they owe somebody X, Y, Z, and actually it's way higher than you think it's going to be.
Yeah, that can be a problem. Or you're missing things completely. So it's not handy.
Give a quick overview then of what a balance sheet is and what that means.
Okay, well, a balance sheet is, to extend on a list of what you own and what you owe, it's a list of your fixed assets plus your current assets less any liabilities. So the balance sheet has two parts that, going by the name, have to balance off. And if you have assets and liabilities, they will have been funded by profits or losses both in the current year and previous years. So this is represented as the equity section at the bottom of your balance sheet, which sums to your fixed assets plus your current assets less your liabilities, hence the balance sheet.
Yeah, now some people view their balance sheet, look at their balance sheet and think, well, this represents how much my company is worth. And that's right in the very sort of a loose sense. It's the financial value of your company at that point in time. That doesn't mean that that is the value of what you've got in your head, in your pipeline, that your business potential is. So if you were going to value a company, the balance sheet is only a small element of that. So don't be misled if you think, if you've got lots of cash in there, thinking that's the level of balance in your balance sheet and that's what your company's worth, because there are other ways of valuing a business.
Yeah.
So when we're looking at a balance sheet, the first thing we're going to be looking at is our fixed assets. They usually appear at the top, except unusually in zero. Zero has your current assets at the top, or your bank and cash at the top, and then your fixed assets down below. So the fixed assets need to be recorded in your balance sheet properly. And so what do we mean by that? Well, a fixed asset is a thing that is sort of generally a tangible fixed asset is something that's tangible, visible, like a computer or an office desk or a building or something like that. It's something that you can touch, you can physically kick, and it has a lifetime worth. So it might last for sort of 2 years, 10 years, depending on what it is. But it's something that shouldn't be written off immediately into your P&L. Now, what we do sometimes see with balance sheets is that the assets are in there and they're recorded, but they're not being depreciated. So that depreciation charge is not being charged to the P&L, which means your assets are overstated in your balance sheet, and then the P&L is understated because you've not provided for that cost. So we also find sometimes that fixed assets, there might not be an asset register. So you might say have 50 or 60,000 pounds worth of assets in a company, and I'm looking at a set of accounts this week that has exactly that. They've got about 60,000 pounds worth of assets, no asset register, and the directors have absolutely no idea what that's made up of. And frustratingly, neither do their accountants.
Yeah. And then you've got the problem of out of that, when you do eventually somehow work out what is in it, you might find that half the assets are no longer in existence.
Quite
so that's all of a sudden quite a problem, because you're overstating a balance sheet of an asset that shouldn't be there in the first place. Now, one thing I will personally say is really, really useful when reviewing your fixed assets is normally when you open up a balance sheet, it will be reviewing the current year versus the previous year. Now, that's all well and good. It sees your movement between the years. But for analysing trends in the balance sheet, I find personally it's better to look at current period and compare it to, say, the previous however many months.
Yeah, I quite like to look at the last 6, and I can see what's happened in the most recent 6 months.
And then that makes it really clear, because if you've got any assets that come in, you can see when they're added, and if they haven't been added, but you knew you bought something at the time, then it's somewhere else. Yeah. So it's a really good indication. And also you can see various trends like whether or not your depreciation's actually been run.
Yeah.
So really, really useful that.
Yeah, and both Xero and QuickBooks have fixed asset functionalities that allow you to register your fixed asset and then set up a depreciation schedule for it, and then have that depreciate by month, usually by a click of a button to depreciate those assets. So if you have got assets in your system and you're not depreciating them, have a look in the help section and see if you can set those up and get them depreciated. It'll make your accounts make a lot more sense.
Yeah.
So next, current assets, Harry?
So current assets will include items such as your bank account, which we recommend must be reconciled at least monthly. Some of you may do it more frequently. I mean, some of you may do it daily, others may do it weekly. It will depend on whatever your business requirements are, but should be reconciled monthly at least.
At least.
Same with cash. Obviously, we find a lot of time with petty cash. Some people don't have as many transactions in the petty cash account, so they may just reconcile it monthly rather than doing it daily or weekly. But definitely has to be done. And of course, there's also going to be stock in your current assets. Now, this one, the requirement for this sort of depends on how much stock your business holds, how frequently it sells it, etc. Most businesses who don't operate with stock, businesses don't operate with stock, obviously don't need to worry about it. Businesses who operate with stock quite heavily will probably do this quite frequently, but we should be reviewing the stock figures in the balance sheet against what we have in our stock records. So we want to make sure that actually the system tallies up to what we would expect. Now, I would say at least quarterly if you don't rely on stock too much, but some of the bigger businesses will probably be looking at monthly for this one as well.
It also depends whether you've got a stock system in place. So when you're small, putting a stock control system in place and building that into your accounts is quite difficult. So a lot of people rely on, a visual check and, maybe a full proper stock check, tick and bash exercise at the end of each year. So we would recommend going through and reviewing your stock balances and making sure they look sensible once a quarter. I mean, you should have a rough idea of what your stock's valued, what the big ticket items are, and whether your stock values in your balance sheet and your cost of sales balance in your P&L are sensible. And that's really all it is. It's just a sense check at the end of each quarter. At the end of each year, when it comes to your accountant doing your annual accounts, they should be asking you for a proper verified stock figure. And that should be a tick and bash exercise, going down and counting what you've got, looking at the valuation, which does get more complicated the bigger you get, and if you don't have that stock control system in place. So Xero and QuickBooks, I think QuickBooks has very basic stock control functionality, but there are many add-ons to both systems that could be used to manage stock more effectively.
Yeah. Other things to look in your current assets, aside from stock, cash and bank, are also items such as prepayments. So we mentioned previously with the P&L, if you've got lumpy costs, these will be prepaid across, say, 12-month period if they are, say, an insurance fee. Now, in your balance sheet, we would expect to see these prepayments sitting as a current asset temporarily until they're reversed back into the P&L. So what you'll see is a trend across the months, and what you should hopefully see is, one, that you've got prepayments if you've got lumpy invoices, and two, that they're actually reversing out of the balance sheet. Because I have seen it on many, many occasions where you've got prepayments sitting in the balance sheet, but when you review it across years or months, there's no movement.
Reversed, no.
So there's physically costs sitting in there.
So what we often see when we look at a set of accounts is the opening balance will be there in the brought forward figures, and then nothing's changed during the year. And quite frequently you'll see accountants have a tendency to just make those adjustments at year end. The problem with that is that for that entire year, your P&L is not accurate, and it's not reflecting the cost that you paid for last year that belongs in this year. So I would recommend setting up your prepayments. And if you can't do it, talk to your bookkeeper and accountant and get them to do it. So set your prepayments up so that they work on a reversing schedule. So when we set a prepayment up, we have an invoice that comes in. So for example, a rate invoice comes in, you post that rates invoice and you post it to your P&L. So you've got the whole annual charge in your P&L. We then journal out that annual charge. So you've got the audit trail of it coming in and then the audit trail of it going out. Don't just post it direct to prepayments.
It gets hidden when you do it.
It gets hidden when you do it. Yeah, exactly. And then you forget about it, or it's not quite so obvious. Put it in your P&L so it stands out like a sore thumb when you do your monthly reviews. Defer that out because you're going to prepay it. And then do your 12 months worth of prepayment journals as you post the invoice, and write them with the first of the month date for prepayment, so that at the end of the day, you've processed the whole thing once and you don't have to think about it again. So it's a set and forget process. And the reason we do that is because we don't want to have to keep going back and reconciling the prepayments account every month. So your check, if you went to look at your prepayments account, is that you run a prepayments account that starts from today and say, an end date of 2022, and make sure that that balance is zero. And that's your control that journal has reversed 12 transactions. Now you do need to check those dates by listing your journals in your manual journals if you're in zero, just double checking that you've got one journal entry for each of the months that you need to reverse by. And that's a simple control for making sure that you haven't missed any of your journals, and it makes sure that you don't have to go back and think about it again.
Yeah, makes a big difference. That.
Huge, doesn't it?
And it's such a quick check, which is so much better than having to look at it every single month and trying to work out what you're missing.
So we teach all our bookkeeping clients how to do that, so that they've got that control in place.
Yeah. Then what else goes on the balance sheet, Lise?
Okay, so we've got fixed assets and current assets. You've always got liabilities. So the most common liabilities are things like loans. So quite often you get an annual loan statement. So make sure you use that to reconcile to your statement properly. If you've got an interest charge, which is on a recurring balance basis, the interest charge will reduce each month as the capital pays down. So you can estimate that if you don't have an interest schedule set about you. Or you can create an annuity schedule, which is, there's an Excel template for that, or you can get your accountant to do it for you because it can be quite complicated. Some lenders will give you a full schedule at the beginning of the loan that will show you the monthly repayment and the monthly interest charge, but use that to make sure that the interest charge that you're paying each month gets posted to your P&L as a cost, which is tax deductible, and not to your balance sheet and paying down the capital. So a really common error we see in balance sheet reviews is that the interest charge is being posted to the balance sheet, and it makes it look like the loan is being paid down faster than it actually is.
And you've got no cost of actually having the loan in place.
Yeah. So then the next thing we need to look at is accruals. So these are costs that we know we've incurred. So say, for example, we've bought some consultancy, but we haven't received that invoice yet. What we would do is then accrue that cost in the P&L so that you've got the charge, say, in May. But if the invoice comes in June, you want to make sure that cost is properly reflected in May. So it sits in your balance sheet it's a debit in your P&L and a credit in your balance sheet, because you owe somebody for that service that you have been billed or you have consumed, but you haven't been billed yet. Lease agreements, very much the same as loan agreements, but sometimes there's a hidden VAT charge in there. So make sure that you've captured your lease agreements. And if it's a lease rental, make sure it's gone into your P&L and not into your balance sheet. So we do often see lease payments going into the balance sheet, but the balance sheet has no liability to reduce because it's a rental charge really, not a lease repayment.
Yeah.
Even though it's often sometimes called a lease. Then we've got our HMRC liabilities. So PAYE, if you're up to date with your PAYE, the current month's payment should pay off last month's VAT liability. So it should be quite a clean reconciliation. VAT, slightly more complicated, especially if you're cash accounting for VAT, but you'd like to see in your VAT liability account that this matches what HMRC think you owe at the end of your VAT quarter if you're accrual accounting. If you're not accrual accounting, you're cash accounting, it's a bit more complicated to check that your actual VAT liability is accurate for, based on what you owe HMRC. And the only way to do that is to look at your aged payables and your aged receivables at the end of your VAT quarter. Take off your liability as submitted to HMRC, and what's left is effectively a timing difference between your cash accounted for VAT and the invoice, the VAT in your invoices. You see Henry down the back there. The VAT on your invoices that you haven't paid or been paid yet. So if you can run an aged receivables and payables, which includes the VAT calculations, then you can double check that or use that to verify your VAT liability. So it's quite complicated to explain on a video, but if you need help with that, let us know. We can do another video.
HMRC is one of the more tricky elements of reconciling your balance sheet, I would say. Now,
a lot of people do completely ignore that and leave that down to their accountant to reconcile at year end, but we find that a lot of accountants don't reconcile it at year end. Some do, some don't. So you need to have a conversation with your accountant like that. Corporation tax should be an accrual in your P&L. So you should have a charge at the end of your tax year for your corporation tax charge, and then a liability in your balance sheet. And it will sit there for 9 months until you pay your corporation tax off. So once it's paid off, then the liability in your balance sheet should reduce to zero. What we often find is that people have posted their corporation tax payment to the P&L. So it looks like there's a cost in the P&L and something still owing in the balance sheet. So watch out for that.
Yep.
Now, by far, the most important the most important account in a limited company set of accounts is the director's loan account. And why is that, Harry?
So the director's loan account is basically whenever you as directors take any funds out of the business, or you have anything paid, any personal expense paid for by the business, this will end up in your director's loan account. Now, the main issue with this is that as a limited company, remember that you, as a director, are completely separate legal entities to the company.
You're the officer of the company. You're not the company.
So you don't actually physically own any of that money. It still belongs to the company until they're able to declare dividends to clear down your director's loan account. So basically what happened is money comes out, builds up in your director's loan account, and then at the end of the year, we have to make sure that the company has generated sufficient profits to be able to pay dividends, which clear your director's loan account.
So how else can you pay down your director's loan account? There's a couple of other things, isn't there?
There are. So there's several tricks we can use. Well, I say tricks. They're not really tricks. There's several ways. Yeah, strategies. There's several strategies to pay down your director's loan account and reduce the balance. So first thing I would say is make sure you monitor this account. And I would say monitor it monthly at least, because you want to make sure it's not spiraling out of control, because it can do. It just depends on how your business is performing, how much you're drawing. It can spiral if you're not careful.
Often happens in those companies are in their growth period, isn't it?
Yes.
It's not quite paying enough for the directors to manage their living expenses, and it's building up and it's building up and it's building up. But what it does is it spirals out of control really, really quickly.
Yeah.
So it's so important to work with your accountant if you're not cash and profit rich. So important to work really closely with your accountant to keep an eye on your director's loan account and make sure you are not going to end up in trouble later on.
Yeah. If it does get overdrawn, you can incur additional charges.
Of a whopping
32.5%. So it is quite a hefty penalty to have an overdrawn balance. But good news is we can try and reduce the chances for that by doing some items. And actually, the funny part about reducing your DLA is there's so many tips and ideas you can do that some directors just simply aren't aware of. Strategies. We'll use strategies. I keep forgetting that. So firstly, your director's loan account can be offset by director wages. So if you run a payroll, the net pay generated from the payroll can offset your director's loan account.
Unless, of course, a lot of companies just take the cash. So some companies pay, or some directors pay themselves the actual amount of their director's wages as director's wages, so it just offsets net wages payable.
Exactly.
Some, for example, might just take £1,500 a month, or £2,000 a month, or £1,000 a week, or something like that, depending on what works for that particular company.
Yeah.
But director's wages is one of the things that we can use to offset the cash that you've drawn from your business.
Very handy. Other items are director expenses. So if you've paid for absolutely anything that's related to the business, so I mean, like
wholly and exclusive
use of the business. So if you've, it depends on your situation, but you might have had a company where it had a bill and you might have paid it through on a personal credit card. Items such as this you want to capture because you should still have the expense in your business account.
Or simple cash spends. That's common, isn't it?
And cash spends very easy to forget about.
Which is where things like receipt
down the side of the van and stuff.
Yeah. So that's where things like Receipt Bank come in handy, or HubDoc, where you can take a picture of that receipt and push it through to the company. If it's not obvious that it's been paid for through a bank expense, it's usually been paid directly by the director, so it gets offset to the DLA.
Yeah. And there's other expenses where you might have incurred a physical cash payment out. So things like mileage, which you might not have claimed for. Working from home expenses, and there's several aspects to really how you can do these claims. That's a separate topic in itself because there's quite a lot of detail that goes into that. But so many people don't think to claim for so many different expenses and end up just losing out on it. So these can really reduce the director's loan account balance.
Yes, I was talking to one client this week who's suddenly realised that he's paying for some of his software. It's on one of these ongoing subscriptions, and it was actually paid for on his personal debit card because he didn't have his company card on him at the time. And that's been going on for 2 years, and he's only just realised that that's been sitting there in the background. He thought it was something entirely different. When he looked into it, it was actually a business spend.
Yeah.
So he's got £500 coming back to him this month. So that's quite nice.
It is really handy. So although getting out of a situation we've got an overdraw DLA can be difficult, it is very possible. And it's just making sure that you've captured everything that you physically can. And the good thing about it all is it's all completely legal. That's the main part of it. Don't want to do anything naughty, so we want to make sure we capture all the legal reclaims. Emphasize that.
Now we did. We have a couple of clients at the moment with overdrawn directors' loan accounts, and we're working with them using a lot of the principles that we talked through with the Profit First reviews last week. Looking at controlling your expenses, looking at reducing your overheads, looking at reducing staff costs if you've got a staff heavy organisation and sometimes you have to make do without in order to cut your cloth to fit your business income. They're working really hard on pushing the income up and going back to core services, back to the things that they do best in order to generate more revenue. And then they've looked at their personal expenses, and the personal expenses have been cut, and they've trimmed down going out, they've trimmed down unnecessary spends, they've restructured personal debts and things like that. And all of these have meant that very suddenly they've gone from having a negative director's loan account to it's still negative at the moment, but it's reducing by a substantial chunk each month as all of these strategies that they've put in place to reduce their DLA have started to have action.
Yeah. But this is why you review it monthly.
Yeah.
Because if you review it at the year end, and that's the first time you've ever looked at it, it's suddenly very hard to make actions based on that, because other than identifying missing expenses, etc., you can't really act to change your business behaviour and your personal behaviour because it's already happened. And
it's also why it's so important, if you're not up to date, to have a week like this, doing a bookkeeping bootcamp and bringing everything up to date so that you can see where you are and whether you're overdrawn or not, and then you can put strategies in place. So it's so important to record or measure what you spend and then manage what you measure. If you don't do that, You just are never in control of your business, and it becomes in charge of you. So there we are. We've done 5 days of our bookkeeping bootcamp. So that's it for this week, and we'll look forward to seeing you next week on a new subject. We'll speak to you soon.
Bye.
Bye.